If you have been listening to the news lately, then I'm sure there's this one term, FDIC insurance, that you have heard a lot about. And like most people, there is very few legitimate websites, and that explains it very clearly and what FDIC insurance means and what it covers. So in this video, we're just trying to go over some of the basics of FDIC insurance and how it works. So first, let's see what is FDIC insurance. So FDIC stands for Federal Deposit Insurance Corporation. So it's basically an insurance company. It started in 1934. It's an independent agency of the US government. It protects depositors of insured banks. So now one of the things that you have to think about is that not all banks might be insured. So you have to be careful about which banks are insured and which are not. And then it's backed by full faith and credit of the US government. So if you have money at a FDIC insured bank, then you are under the limit of $250,000, which we are going to discuss later, then you probably cannot lose your deposits if the bank fails. And so let's see how the basics of FDIC insurance works. So what FDIC covers, it covers deposit accounts dollar for dollar at your covered bank. The accounts that are covered are checking, savings, money market, and CD account. The accounts that are not covered, even though they might be at the bank, are your investment account. So most of the banks or some of the banks would have an investment division. And if your assets are in the investment division or are invested in stocks, bonds, or life insurance policies or annuities, they are not covered. But if you go to the teller window, and that's where you have your checking, savings, and money market and CDs, that's probably what is covered in FDIC. So FDIC covers $250,000 per depositor, per insured bank, per ownership type. So one of the misconceptions that most people have is that it is account type. It is not. So it is per depositor, per insured bank, per ownership type. So let's see how, let's look at an example. So Mary has an account in Bank X. It is an individual account, so the ownership is individual. Now she has a checking account, savings account, and a money market account. Let's say she has $100,000 in checking, savings, and money market each, making her a total of $300,000. What is covered by FDIC is $250,000 for Mary because that is per depositor, per insured bank, and per ownership type. So from her $300,000, $50,000 is not insured because even though it's a different account type, the total that is covered is $250,000 for Mary. So she should probably move the $50,000 to some other bank and have the same structure and be covered for $250,000. Now, let's see if Mary has a joint account with her husband. So another common ownership that we see in accounts is joint ownership between spouses. So Mary and Bob have a joint account. And for a joint account, the way coverage works, it's $250,000 per person for the joint ownership. The joint ownership is a different account type than the individual account. So Mary can have her individual coverage for $250,000, and then she can have a joint account with Bob, and that coverage would be a total of $500,000. So essentially, Mary can have two accounts in the same bank and be covered for $750,000, $250,000 for her individual ownership, and $500,000 for her joint ownership. So Mary's individual $250,000 of the joint, assuming Mary is 50% owner, she has the $250,000. So Mary's coverage is $500,000. Bob can have the individual account for $250,000. Bob can have the joint account, which he'll be covered for $250,000 for $500,000. So together, Mary and Bob can have accounts at the same institution and be covered for $1 million if they have two individual accounts and one joint account. Now let's look at another very common ownership type, which is trust account or what we call a POD or a TOD account. But what POD or TOD stands for is payable on death or transfer on death. So in that case, what happens is, like, if Mary and Bob have kids and they want the money to go to their kids, if something happens to them, then in that case, they would open ownership type, which is called the trust ownership. In that case, the coverage is $250,000 per owner multiplied by the number of beneficiaries. So, and the qualification for a beneficiary is that it has to be a living person or charity or a nonprofit organization. So, for example, Mary has a TOD account where she names her child 1 as the beneficiary. So this is a different ownership type than her individual account. So this would be separately covered for $250,000. Now let's see that Mary and Bob have an account where they name their child 1 as the beneficiary. Again, this is joint account with Mary and Bob, but because they have a TOD on this, it's a different ownership than the joint account. So this account would be covered for $500,000 because the coverage is $250,000 per owner multiplied by the beneficiary. So it's Mary's ownership to the beneficiary, Bob's ownership to the beneficiary, making the coverage to $500,000. And now if, say, they have child number 2, so what should they do? Then Mary and Bob, TOD child 1 and child 2, in that case, the coverage could be million because it's going to be Mary to child 1, Mary to child 2, Bob to child 1, and Bob to child 2, making the coverage 1 million. Now, one thing to remember is that all these are one ownership type accounts. So it's not that Mary can have a separate account with Mary TOD child 1 and Mary and Bob TOD child 1 and 2. That's not going to work. So it has to be, you have to remember that the coverage is $250,000 per owner multiplied by the number of beneficiaries and not the number of accounts. So, but as you see that there are a couple of ways where you can keep your money at the same institution and still have more coverage than $250,000. In this video, I haven't covered IRAs. IRAs probably are a different ownership type. And for example, if Mary has an IRA account or a Roth IRA account, then that would be separate ownership type covered for $250,000. FDIC website does a really good job of explaining the coverage, so probably that's a trusted resource to visit. Other than that, it is very simple. You just have to remember the ownership type of the account. This video is not meant to be a personal financial advice and is only supposed to be used for educational purposes only.